Very esteemed members, as the chairman of the Management Accounting Committee of the Institute of Chartered Accountants of India, it gives me immense pleasure to welcome each and every one of you for this special webcast on Treasury Management. On your screens, you can see CA Gyan Chandra Misra, the Honorable Central Council member and a very vibrant and active vice chairman of the Management Accounting Committee. A person very much wedded to the institute, a person whom you can see with his coat, and he is also wearing the ICI pin and the Sustainability Development Gold pin also. Gyanchand Misraji, I welcome you to this special webcast.
Thank you, sir. Chairman, sir. Very, thank you, sir.
Thank you, Misraji. And we also see T.R. Shastri, sir. Except for the glasses, both of us are similar. Both of us are similar, Mr. T.R. Shastri. And you also can see a very vibrant secretary of this committee, Shakun Goyal, madam. I welcome each and every one of you to this special webcast of our committee. The Management Accounting Committee is not very well known in the circles of the chartered accountants, but management is a key function. This particular committee has organized innumerable number of webcasts for those who are wedded to the managerial functions of their respective organizations, especially the members who are in industry. The Treasury plays a very important role, functional role, as to say, in every aspect of corporate. So today, for the next 2 hours, we have a very dynamic faculty, T.R. Shastri sir, who is going to deliberate on this topic and take us through. Friends, I now request our Gyanchand Misra sir to take over the proceedings and conduct it from here so that later on he can hand it over to Mr. T.R. Shastri. Gyanchand Misra ji, welcome once again to you. It is very nice to see your smiling face and of course with a well-dressed attire that you have worn today. Thank you very much. Over to you, sir.
So thank you, very respected Chairman, C.A. Rajendra Kumar PG. In fact, since I joined the council, I have seen his dedication and devotion for the profession. And sir, I really compliment you for your untired effort to give training to the GST officials across the country and making the brand building of ICI and taking the flag at higher and higher level. Sir, I am really happy that you have given this opportunity to interact with the members and of course to introduce our learned speaker T.R. Shastri ji on a webinar of very important topic, that is Treasury Management. So let me friends introduce our learned speaker, Mr. T.R. Shastri ji. Shastri ji is a postgraduate in science and is an associate of Indian Institute of Bankers and of the Chartered Accountants Institute of Bankers and London with the distinction in accountancy. Before joining ICICI Manipal Academy as Dean since its inception in 2008, he had worked in ICFAI Business School as faculty and had worked for long in Canara Bank, both in India and abroad. He had also worked in a private sector bank as head of international trade and treasury. He has more than 30 years of banking experience, 3 years of consulting experience, besides teaching experience of over 10 years. He has trained in a leading bank in London and has attended international seminars in Frankfurt, Singapore, Sydney, and various other countries. His current areas of interest include HR applications relevant to bankers, international trade facilitation, and forex risk management. He is an alumni of the prestigious International Teachers Program, having undergone the studies of HEC Paris. He was felicitated by Chairman of ICICI Bank during the convocation in 2012 for exemplary service rendered as founding dean of IMA. Till recently, he was working as joint director in Manipal Academy of Banking, handling inter alia training the trainers, quality of education and HR initiative with partners in Malaysia, UAE, and elsewhere. Presently, he is working as industry expert for a finance accreditation agency in Malaysia, supported by Central Bank there. He has authored a book in FEMA with a foreword by the then chief executive of FEDI, which was well reviewed in media besides editing couple of books. His hundreds of articles have appeared mainly relating to the treasury, trade and banking in a number of publication and trade magazines. He has been a regular guest faculty in leading universities, banks and institutions, including ICI. He strongly believes that TRS stands for teaching, research and service to institution, essential quality of a teacher. So while undergoing his profile, I was thinking that no other person could be fit for the webinar than TR Sastri ji to let the professionals learn about the treasury management. So I welcome Sastri sir to you from core of my heart, and on behalf of the committee and on behalf of chairman and present over here. I welcome all the participants also, and I hope that this would be a wonderful knowledge enriching session for all of us. Thank you, Chairman sir, for giving this opportunity.
Thank you. Honorable Vice Chairman sir, for introducing the credentials of TR Shastri sir. Teaching, Research and Service, TRS. What a wonderful combination of all these three factors we have here today. It also signifies the ICAI, which is also into teaching, research, and of course, service to humanity, service to mankind. Shastri sir, with so much credentials, you have come to our institute platform today. One more time, I sincerely thank you, sir, and I request you to please deliberate with our members in this particular program. Thank you very much. Over to you, sir.
Thank you. Thank you. Good afternoon to all. So let me share the screen and then the PPT and then we'll start.
Yes, sir.
Okay, now is the PPT visible and am I audible to all? Particularly,
you are very clearly visible and your PPT is also very nicely visible and you're audible, sir.
Thank you. Thank you. So good afternoon, and it's a great pleasure to have finance colleagues assembled to discuss on this, talk on this, or understand on this subject called treasury management on an afternoon session, 3 to 5 o'clock, which is the least productive time of the day as far as absorption is concerned. But this treasury is such an exciting subject that I think the 3 to 5 is the best time to learn or to understand it, because it excites all of us. Treasury is not something which is foreign to any of us. For all of us, it is relevant. I'll give you a simple example. Each of us work as a treasurer as and when required. So one simple example is, if I have taken a home loan, I would have thought several times, should it be for 20 years or 25 years? Should it be on a floating rate or should it be on a fixed rate? There could be a variety of such thought processes, after analyzing which, I would have decided to go for a home loan. Go for a home loan from A bank, B bank, C company, D company, etc., etc. All those factors which we analyzed are the duties of a treasurer. What does it mean? I put on the hat of a treasurer at that point of time before deciding where to go. So therefore, treasury is like, in spiritual thoughts, people say, they say that the God is inside your heart. Treasury is inside all of us. Only thing is, we use it where required. Only thing is, we don't remember or we don't specifically call ourselves as a treasurer at that time, because the word appears to be too sort of a great word. Anyway, that is a background. So treasury is something which all of us should be common. All of us are fairly using it or fairly familiar with that. With that understanding, let me go ahead with this my presentation. These are the topics. I hope even when it is on a presentation mode, hopefully it is all visible. So these are broadly the areas which I propose to discuss. It means basically starting from, I presume here, one presumption is, I presume that many of the participants, which may be a wrong presumption, they are not familiar with treasury. Hence, I start with the basics. So what happens is in a group of like this, where there is a sort of academic heterogeneity, some of you may be experts, some of there may be participants who are already working in treasury, or you may be auditing treasury. So to them, this may look little elementary, the first couple of slides. To that extent, I think we may have to tolerate with each other. So let me start with as a basics, then define what is the objective of a treasury, why exactly there should be treasury, what type of organization should have treasuries, when it is required and all. Treasury, we know, is some sort of a high volume activity. We have heard about it, even though we are not aware what is treasury. So what are the control measures? Because it is a lot of live wire situation. Is it that there should be a lot of control, or it should be a free play, it should be allowed? What are the control measures? Is there a regulator? Is a regulator involved in this? Is the regulator interested in controlling? All that we will discuss. Subject to, of course, the time, we will at least broadly discuss that. Then, of course, what are the challenges faced by a treasury or a treasurer? If tomorrow I'm getting into a treasury, I'm establishing a new treasury in our organization, in our company, or if I'm going to take up the audit of a treasury, what are the challenges I should bear in mind so that it does not become a sort of accident, it doesn't meet with an accident? Then what are the opportunities for a treasury? This, of course, bit unofficial slide, in the sense, some of you who are young, if you are thinking about treasury, because the word treasury is quite exciting, it looks little axiomatic, or it's little something which I'm curious to know. If that is the case, are there good opportunities for treasury? We will discuss. Then, of course, the most important thing is for the last few years, in fact, there is a lot of digitization. The automation has taken place in every area, including in treasury. New types of assets have come up. Digital assets have come up where treasuries can invest the surplus, or there are platforms, digital platforms where treasury can borrow. So depending on the cost of borrowing or revenue on investment, these are possibilities. It could be through somewhat a cryptocurrency, subject to, of course, regulatory compliance, etc. So variety of investment and borrowing opportunities have been affected by digital transformation, by digital or automated treasuries. In fact, we will discuss that when we go to the slide. With all that, what is the basic objective? What is the basic purpose of this whole discussion? What are we going to achieve? Hopefully, at the end of the discussion, we will have, if not a detailed view, a broad view of what is meant by what the treasurer does, what are the functions, what are the challenges faced by a treasurer or treasury, and of course, opportunities available to us, and what is the current trend, what is it going on presently. So we will try to get a broad view of this during the next 1.5 hours or the nearly 2 hours, whatever time available and all. And as I said, because it's an afternoon session, it would be good if there could be a good interaction. Of course, in a webinar, the scope for interaction is slightly less than that on a face-to-face classroom. But then if possible, I think there is a way in which you can ask, the chat box is there, you can type, or I don't know how it is organized. Otherwise, at the end of it, definitely we have some 10-15 minutes of time, because the Q&A or discussions are more important than my giving a monologue of lecturing. You know, lecture and torture, they sound very similar. So I have no intention of torturing you in an afternoon. So let me confine myself to very less of lecturing, and perhaps try to understand what are your questions, and if I know, I will answer. So with that background, let me go to the next slide. So what is treasury? Of course, all of you know about it, but this is sort of academic definition, or for example, a sort of crystallizing our thought process on that. What is treasury? What is treasure? The word treasury has come from the word treasure. What is treasure? Treasure is something very valuable. And as finance professionals, we all know what is valuable. This may be a piece of paper. This is just a piece of paper, but this has no value, or rather its value is zero, because it's just a piece of paper. It's almost 0.00001 rupee. But on the other hand, if this piece of paper has been used to write a warehouse receipt in its format, etc., it has been used to print that, and somebody has signed, it is a regular warehouse receipt, or if it is a currency note, or if it is a bill of exchange signed by a corporate, etc., a variety of government security, all that, then this becomes very valuable. So treasure means basically value, something valuable, but we in finance field, obviously we don't think about, for example, the urud dal stored somewhere in a warehouse, but we talk about the warehouse receipt representing the value. That means basically treasure for us is nothing but a financial security. That means is a document which represents, which has a value more than its nominal value, more than the piece of value of the piece of paper. I mean, I think you know about it. What is a treasury? What is treasury? Treasury is basically nothing but handling these valuable documents. Lots of pieces of paper. I mean, piece of paper is a very, very crude word to tell, but basically dealing in documents. Treasury deals in documents. What type of documents? Documents which represent financial value, which represent, it could be bill of lading, it could be bill of exchange, it could be a promissory note, it could be a warehouse receipt, it could be government security, it could be currencies, it could be a deposit, a receipt, or held it, or it may be some sort of deposit receipt held in another organization, bank, NBFC, etc., etc. But one of the conditions we would like to have in financial security, the value is it should be necessarily be possible to transfer. What is the point in, for example, you think of Taj Mahal. Taj Mahal is a great asset, no doubt about it. Its value perhaps is almost impossible to estimate. Even if there is a printed piece of paper which tells the ownership of Taj Mahal, it's unlikely that it's of interest to us as treasurers, because basically you can't sell it. There are no buyers. Either the value is too high or it's not a tradable commodity as such. It's a very valuable. There's no doubt about it, but it's not being traded. So we are interested in treasury, those financial securities which are tradable. What's not tradable? Basically negotiable. That means it can be bought and sold, where the buyer gets full rights. You know the concept of negotiable. So it's a negotiable, that a warehouse receipt is a negotiable instrument. It's a negotiable security. Government security is a negotiable instrument. Like that and all. Bill of exchange is a negotiable instrument. So treasury is handling that. Treasury handles such documents. Treasury was part of the word of treasury was referring to the government departments, where people used to go there, pay taxes or get some salary, etc. Treasury was more like a finance department of the government earlier, which now it has changed. Treasurer was in charge of the treasury, for example, Inland Revenue Services of United States or His Majesty Treasury of UK, etc., etc. They were treasuries in our own government. For example, long ago, some very senior people may be knowing about treasury, some sort of 40-watt bulb, dark corners, etc., etc. You didn't feel like going there. It's obviously there is no trading center. It was more a sort of where valuables are held, locked, and kept and dispersed. Either receipt was taken or payment was made, etc. So that is a sort of original picture we get by the word treasury. But of course, now refers to a non-government entity also. We will see in the next one of the slides. What are the types of organizations which have a treasury? Because that helps us also to understand what is the scope. If I am new to treasury, if I am young, I may be interested to get into treasury. So I know what are the types of corporations or organizations where there is a good possibility of a treasurer, of a job for, or am I building a career in treasury? Why treasury generally relates to banks. In fact, in one of the, after the government, which was handling cash, which are receipts and revenue, the next organization which handles cash is generally, we know, banks. There are many other organizations like NBFCs, insurance company, etc. They also handle cash. But then to our mind, when we think about the cash, immediately we think about bank. Because bank handles cash in the sense it's not physical cash, the receipts and payments. Its raw material is in the form of cash. Its work in progress is cash. Its final end product is also cash. That means it accepts deposits from somebody, visualize it as a raw material. Maybe it is a 2-year deposit. It transforms it and gives it as a 10-year loan to or a 5-year vehicle loan to somebody, or a 20-year home loan to a customer, etc., etc. That means, the final product as a loan product or the deposit as a raw material, if you visualize that way, that's all full of cash. So that is why the treasury is an essential requirement for a bank. For a corporation, if it is in a small scale, its complications are less, there may not be treasury. But there can't be a bank without a treasury. As simple as that. So that's why we generally have a treasury. We relate that to banks. What are the objectives of treasury management? What is the objectives of treasury management? First of all, we should understand what is into management. Treasury management. See, we hope, or at least I hope, that we have a rough idea now what is into a treasury. In an organization, I think all that finance department, we almost broadly categorize along with treasury. For the time being, it's okay. In the next second, third, fourth, fifth slide, we'll try to understand broadly what's the difference between a finance department and a treasury department. I am on Yeah, including the first one. It's in fact the heading is objective of treasury management. Should I stop sharing and then start? Okay. Thank you. Thank you for pointing it out. Okay, I think I hope that screen is visible. Yeah. Did it go to agenda, understanding what is treasury? Treasury. Did it go to second slide? Okay, then are you able to see the next slide, treasury? What is treasury, etc.? Agenda, treasury. Then of course, then I was in this slide, objective of treasury management. Yeah, thank you for pointing out. In case it is anytime if it happens like that, either voice is muted or please feel free. Yeah, please, thank you. And I hope what you are saying, technical support team telling, is applicable to participants also, because it may so happen that he is able to see it or hear, some participant is not, because basically the idea is that we should be able to, our wavelength should match in the sense we to tell. So any participant is also free to give the feedback either to me or to the technical team. Okay. So subject to that, what is the objective of treasury management? But before that, we should understand what is on to treasury, what is on to treasury managing. Managing what? Treasury, why it should be managed? That's a basic question. I think this slide will talk, and then I'll go back to the previous slide. What is on to treasury management? What is there to manage? Basically, what is on to managing? Basically, there is some issue, hence I am managing. Okay, the manager has come here to sort out some issues. That is the first impression we get with the word manage. So that means what? There are some challenges or there are some issues which are to be sorted out. Hence, the treasury is to be managed. That is the first impression we get. Okay, it is partly for our rough understanding, it is sufficient. It is true. But what is to be managed is something like this. Managing is, or I will go at this stage to the previous slide. Treasury management refers to a set of policy. This is what the issue we have of, it is generally the academic description or the definition of treasury management is, it refers to a set of policies, strategies, and transactions. That means basically about the day-to-day activities, the transactions, and also the laid down policies of the organization. It may be a bank, it may be a company, or it may be even the central bank of the country. That policy or strategy, etc., or what is it actually? What is it for? It is to raise finance at an acceptable cost and risk. This is one objective of the treasury management. As a manager of the treasury, if I am the owner of the treasury, my objective is, if I have finance, I should be able to raise finance at acceptable cost and risk. I know it's a part of the finance department. That will be your first reaction. Okay. Second is, if they have cash surplus, if the company has a cash surplus, it should be optimized. The revenue should be optimized. How? At an acceptable risk. What is not an acceptable risk? If I keep all my 100 crore surplus funds with a cooperative bank which pays me 9.5%, it is a optimization of the revenue, but perhaps there's a risk is not okay to me, because we do not know whether a principal there is an issue while coming back, etc., etc. So acceptable risk. What is not to acceptable risk? That depends on the organization. Every organization has to decide what risk is acceptable. The risk appetite, we use a technical word like that. So they're subject to that. And of course, subject and another sort of complementing that to these two objectives, to reduce risks of interest rate, foreign exchange, commodity price, as well as conducting a relationship with its financial stakeholders, etc. These are all nice things. Risk management. That means basically, if I have to raise funds, it should be at a acceptable cost and risk. It should be, if I have to deploy the funds, it should be optimization of the revenue at acceptable risk. But the subject to these two activities are subject to the overall risk management that I defined before even starting this treasury or treasury activity. I, as an owner of this organization, I write my risk acceptability or risk management policy. This is acceptable, this is not acceptable. I can't have an exposure beyond so and so amount. I don't want any exposure in, say, for example, New Zealand dollar or something like that, and all. Or I don't want to keep any surplus with the cooperative bank or etc. It could be anything. It could be as elaborate as possible. So that's subject to that, what is written down in the risk management policy. These two activities are binding on us, and that is why it becomes a treasury management. Because what is treasury? Valuable. I should use the valuables in such a way that optimizing the revenue, minimizing the cost, and managing the overall risk. So these, and if you can slowly think about it, these are not very complementary. These are actually against each other. You know, risk and reward go together. I take high risk and the reward will be high. But here the point is, it says reward should be high, but risk should be minimum. So that means I should find out where is the meeting point. That is what is a treasury management is. In other words, to have funds in place where they are needed and to put all cash to the best use. Why I put a cash in red letter is, cash is not that physical cash, basically the receivable, the liquid assets, and best use is optimized use. If it could be optimization of the return subject to risk acceptability. So this is a treasury management, and there is no socialism at all. What's not there is no socialism. There is nothing like a, you know, all should all equal, or for example, there is some priority sector or this much percentage for this type of investments, etc., etc. Even for a government-owned organization, on the treasury activity, there are no such reservations of activities or the ceiling, floor, etc., etc. So that's why I used the word casually. No socialism. Obviously, it is little off the record. So this is what the broad idea of a treasury management is. Subject to that, of course, we have understood. What is under treasury management? We said managing these two. But what is managing what? Money management means money management is nothing but liquidity management. Liquidity, you know, liquidity and yield normally go together or opposite way. Think you can manage it. So if you keep everything in current account, obviously the yield is low. And if the keep it in real estate, prices may go up very faster. The return may be, revenue may be better than other, return may be better than other assets, but obviously the liquidity is a bit poor. So obviously liquidity and yield do not go together, generally speaking. So obviously money management or liquidity management is that. For example, I am the treasurer of a software company. I have surplus of around 500 crores. Management has said, you can invest it in, you have to optimize yield. But remember that we have an idea of acquiring some company, we may require around 450 crore rupee equivalent. So anytime I ask, you should be able to provide that, make it available. Then as a treasurer, I have a big issue because, well, all right, I will keep entire thing in current account. Anytime the management can draw, but the yield is zero. So I put it in fixed deposit. Yeah, okay, we get something very nominally because before maturity, we may have to take it back. And then there is a reduced rate of interest and there is a TDS on the entire thing, etc. So you can visualize in the different types of asset classes, the liquidity management has its own pros and cons, its own advantages and disadvantages. So money management or liquidity management is that issue. This is one of the managing issues of a treasurer. Forex management, I think many of you may be having an idea about it. Basically, in the exchange risk is an added complication. It could be variety. For example, the simplest, you are exporting. Should I export, invoice it in US dollars, euro, sterling, etc. could be a challenge. The buyer may say dictate, then I have no choice. Sometimes you feel, oh, that's the best thing. But if I am in a corporate where the buyer is okay neutral, or let us say the buyer is in somewhere in Africa, and I am invoicing, I am exporting, the African currency or my own, any of the countries' currencies there, or our own Indian rupee are not acceptable to both the sides. So we think about a neutral third currency. So it could be dollar, it could be euro, etc., depending on buyer's preference and our own preference. So there could be an issue. For example, which currency is likely to appreciate better by the time the bill gets realized, etc. It could be for borrowing, it could be for imports, it could be keeping surplus funds, it could be for setting up of a, for example, setting up of a project. If you want to set up a big project, let us say for the 500 crores rupee equivalent of a project, should we invest it in Indonesia? Should we invest it in Taiwan? Somewhere in Far East, we want to do it. Which currency? Local currency, because it gets converted to local currency. If I have to take it back, or on the dividend, there is an exchange risk, etc. So Forex management is not simply relating to import, export, borrowing, keeping surplus, investments, etc., etc. Risk management, other than the business risk. We are not talking about the business risk because that is anyway part of the any business. What we are talking about is the financial risk. So I'll show you a slide giving what are the types of financial risk which the treasurer has to be familiar and has to manage. Credit management, this arises for treasurers of corporates. In a bank, which is a very predominant user of where treasury is very visible, corporate credit management is not a part of treasury. There is a separate department, it's a separate wing, the separate boss's heading credit, etc. There, because the credit is also an equally important or more important activity of the bank. But in corporates, raising funds is generally part of the treasury, particularly large funds. I'm not talking about, okay, 100 crores cash credit has been sanctioned today, we have to draw the money, etc. That some finance people will do it. But then, should we have a rupee borrowing? Should we have it as a term loan? Should we have it as a working capital term loan? Should it be foreign currency borrowing, etc., or the equity, debt, etc. All that raising funds are. Suppose there is a surplus, we want to lend to somebody, to whom to lend, in what form, or invest in what type of securities, etc. They are all part of the credit management, which the treasurer has to manage. It could be across the globe, as I said, mainly for the corporate treasurers. So these are the broad ideas about what's a treasury management. So in these 4, 5, 6 slides, what we have hopefully got a broad overview is what is meant by treasury. Some financial securities having value, not a piece of paper because it has almost no value, but on which something has been written, which is authentic, which carries value, which is tradable. That is a treasury. That is the sort of raw material, or the instruments we use in treasury. And treasury, there are issues because what is the objective? Why should I do it? Why should I handle that as a treasurer? Because they have 2 objectives have been given. So there is a third also. Optimizing the revenue if it is a surplus situation. Minimizing the cost if I have to borrow. And mind you, there are organizations like a lot of finance organizations, banks, NBFCs, etc. They both borrow and lend almost simultaneously. At 10:35, they may be borrowing, 10:35, 10:36, they may be lending, etc. It may continuously happen to make profit. So borrowing and lending are not something written on a stone. So it continuously happens. So optimizing the cost, optimizing the revenue, minimizing the cost. And these 2 are subject to managing the risk. So the risk management, a couple of examples we saw. So these are the broad objectives, and this is the purpose for which a treasurer exists. But this is the only purpose. What happened is managing volatility and risk with regard to cash, liquidity, foreign exchange. That's what we saw. This is also another risk management because volatility could be there. Many of us, for example, we have kept a fixed deposit for say 3 years. Last year we kept it for 3 years because the rate of interest appeared to be good at 5.5%. But now the deposit has not yet matured. The interest rate has already gone up to say, for example, 8% or 7.5%, 7%. So then what happens is the risk or the sort of opportunity loss has taken place as far as the revenue is concerned. I tried to keep the liquidity in mind and then also the optimize the revenue. But in the meanwhile, what happened is the basic interest rates have changed. There has been a volatility in the rate of interest in the market, which affected my investment decision. This is a very small, silly example as an individual, but same thing can happen for a corporate, same thing can happen for a bank or a finance organization. This is interest rate fluctuations are not very as volatile as foreign exchange rate fluctuation. Foreign exchange rates fluctuate much more rapidly, could be minute to minute, second to second, or whatever you call. So there, if you keep for a longer period, you are a company and you are exporting in say US dollars, invoicing in US dollars. It is $1 million question to decide whether to book a forward contract or not. It so happens that I book a forward contract and then the dollar has appreciated substantially. I don't book a forward contract and the dollar has not appreciated at all. So it can happen. So that way, it is not easy to predict. There are methods in which predictions can be made. Sometimes work, sometimes does not work. Interest rate, foreign exchange liquidity, foreign exchange fluctuation, foreign exchange rate fluctuations are actually a little more volatile than compared to interest rate fluctuation. There is significant impact of global financial crisis of 2008 and all on corporate treasurers, because in terms of that, the responsibility has changed because there are a lot of companies which lost money because they invested in some securities or what are called as the secondary market, tertiary market of securities, where in fact it was traded well, but then when the GFC took place, the value crashed, etc. So the responsibility has increased substantially. So the impact sometimes occurs in future years also. The responsibilities therefore have increased in the sense the management says the treasurer, please take care of any future shock also in the financial market. You invest subject to that. But management also says you also optimize the revenue. So these go a little, because the risk and reward, they go together. So how to manage? So that's a question that there is no 100% perfect answer. But then we should remember that. Initially, as I said, treasurer was these two, the basic purpose was there. then say the responsibilities increased. The duty of the treasurer evolved. From liquidity manager, it became a strategic risk manager. Then it became a strategic risk partner. Then became a stakeholder manager. I think liquidity manager we understood. Strategic risk manager, I think you understood whether to book a forward contract or not. What is a strategic risk partner? Partner with whom? Partner with the management itself. See, the treasurer is treated as a separate entity, saying that you manage the funds. But treasurer also can become a sort of partner as far as decision taking is concerned. For example, if the company has decided to expand, for example, put up an office in Europe, where the funds are the base currency is euro, if the treasurer has got a very strong reason saying that euro is likely to depreciate in the next 5 to 10 years in the long range, it may tell the owner, the manager, the management, saying that in my view, for the following ABCD reasons, that euro is likely to depreciate, which means, our long-term investments could be at stake as far as the currency fluctuation is concerned. So would you consider setting up the same thing in, say, USA or somewhere else where so-and-so US dollar is a currency, and so the principal also appreciates in addition to the business profit. Whether to invoice, when the sales department says, the marketing department says, we want to enter into a long-term contract with so-and-so buyer who has agreed to purchase it for the next 5 years, the treasurer may come and slowly tell the marketing manager, please try to see whether you can invoice it in so-and-so currency instead of this currency, because it may give better revenue for the better yield. It may become strategic partner that way, in the sense in your long-term decisions, not on a transaction basis, on the long-run perspective. Stakeholder manager, that means when the treasurer is able to do like that and participate in and contribute substantially to the bottom line, he becomes a stakeholder manager. In the sense, the shareholders perhaps, next time you'll ask, in the last annual finance statements, you said the profit on account of the treasury activities was rupees so much, which is nearly 25%. This year, you are saying it has gone up to 35% at treasurer's activity. So who is the treasurer in charge? I would like to say good morning to him or good evening to him or her. So that means basically the stakeholder look to this treasurer for future profits. Remember, it is not simply managing liquidity or strategic risk manager. The scope has evolved further. We become a basic partner as far as strategic decisions are concerned. Because finance manager normally handles the transactions which is on a short term, which has a short-term range or a transaction basis. Whereas as a treasurer, I look for long-term vision. I have a long-term vision. Of course, if my vision is wrong and it proves wrong multiple times, my job may be at stake. But I'm talking about the role importance of the treasurer. Need arises when this is the next question I want to, because I was talking about the finance transaction and a treasury transaction. When do you think there is a distinction? Or do you think there should be a treasury in every organization? Or treasury and finance are the same? Or there could be some sort of confusion. Obviously, there is nothing like a legally drawn demarcation between the two. But when the need for a treasury arises, where the depth and diversity of financial activities are higher. What does it mean? Let's think of a family organization which has nothing to do with import, export, etc., etc. There is no foreign exchange activity at all. And the conservative management says, we don't want, we have enough business in India and we are happy with that. All right, fine. So foreign exchange risk management is not there. But, okay, what happened to your profit? What is surplus? The management says, no, we are very happy with our bank. They are giving, say, so-and-so percent. Even after TDS, I get a net yield of 3.5%, 4%, etc. Even though it appears to be low, I am very, very happy because I don't want to take any risk at all. That means basically the diversity of the activities is not there. You make business, you earn a profit out of the business, surplus is there, put it in the same bank, and that too the bank, the owner says, we are dealing with this particular bank for the last 20 years or even from my father's time. So we will continue with that bank. It's a government bank. I'm happy with the risk and possible risk, etc. So it is fine. So that means the financial activity depth is less, diversity is less. Depth is not there because there is no further activity other than this. On the other hand, for example, if there is a company which says we want to enter into a export market instead of taking a term loan, I have heard that raising a ECB is cheaper because for the exchange risk we can book a forward contract, etc., etc. So there may be a variety of such ideas coming up. The company may be saying that I am thinking of actually setting up of an office elsewhere abroad because, the blah, blah reason, blah, so much. We raise capital abroad, setting up a subsidiary abroad, all such ideas may be there for that organization. Very good. That means the depth is very high, the diversity is very vast. So obviously treasury is required. Is there a sort of mathematical line when you say that treasury is required, not required? Obviously no. But as far as all finance organizations are concerned, generally there's a treasury. For example, you are thinking of setting up of a home loan NBFs, thinking of a gold finance NBFs. All these activities require obviously the managing the funds, because out of the surplus available in the company, or if it is a finance, housing finance or a gold finance company, there may not be any surplus, there may be borrowing. So that means optimizing the cost or the minimizing the cost or optimizing the revenue, etc. are part of the insurance company. For example, obviously the surplus of the premium received has to grow fast so that you can pay the claims out of the revenue, etc. and still become viable. So that means basically the managing the funds is an essential part for all finance companies. It's a common sense. So obviously that treasury is required. For a corporate, the depth and diversity are important. Otherwise, perhaps may not be. A small size, not much of activities, etc. that may not be required. So as and when a company grows, the treasury comes. What is not the treasury coming into the picture? Initially, there is one person in finance department who handles this type of activities. Long-term vision, raise funds here, there or not. In fact, it may even to think about, for example, should we raise an equity or debt? All are part of the treasurer's activity. A small group, a person handles it, or say a team of small people handle, then there is a separate department, we call it as treasury at that time. What is the reason why this treasury? For example, some 30, 40 years ago, there were no companies which are having treasuries in their organization, or at least a couple of them, or most others did not have corporates. But now perhaps any medium-sized company also talks about treasury. Why? What are the drivers? What are the reasons? One is the deregulation. Interest rates are varying. You could change, you could be floating rate, fixed rate, interest rates. All those options were not there earlier. Now there is an option to think about which is good, not for today's angle, from the future angle, long-term angle if you have to think. It's a specialized lot of thinking, which we call it as a treasurer's activity. That's why I said, I may be doing a normal finance activity. When I start using thinking on these terms, I become a treasurer. So that is a distinction between finance and treasurer activity. There is a regular deregulations in the banking sector. You know about interest rates are now mostly, except one or two areas, all others are free. Free in the sense it's all subject to negotiation, or banks can decide. There's a competition in the capital market. That means the products available in capital markets are high. It could be the currency is the place where to raise capital. It could be India, outside India, etc. All that activity. What about ADR, GDR and all? Bewildering options among financial instruments and partners. Partners, that financial partners, need not necessarily to raise a loan only from a bank, or earlier there used to be term lending institutions, but it can be from an NBFC, specialized NBFC. There could be development in bank institutions, one or two, etc. So there is a variety of institutions available. Financial instruments are also a variety of financial instruments are available in the capital market. Technology has helped in delivery of treasury services. For example, about the algo trading, etc., and all. In fact, even on web, you will be able to raise funds by, subject to the name, subject to usual KYC and many other prerequisites. It is possible to raise. That means basically, technology has facilitated a quick decision. And more importantly, technology also has made available the information flow is becoming much faster. The interest rate changes, exchange rate changes, etc. It is not that yesterday's Singapore rate comes today morning, or today's Singapore rate, based on that we take a decision. It's all what is happening at this point of time in London or Singapore or India. Exchange rates are all the same. It's like in a gold market or any other metal market. Exchange rate also for an exchange is a commodity, so its rate also is uniform. So the technology has helped in sort of normalizing the rates, exchange rates across the markets. So these are all the changes which have happened over a period of time, where the treasurer's activity have evolved, have become either more complicated, or rather more interesting, or more exciting, whatever way we want to look at it. Financial discipline, treasury management is a financial discipline that takes a broad view of the company's financial resources. One way, a broad way of defining that, but that's what we broadly understood also. Why treasury in a bank? I think we understood it. Treasury, because basically it's a starting requirement. Because it deals with money. But there is also one, you must have heard about it, what is called a SLR, statutory liquidity requirement. What does it mean? Every bank is required to maintain a percentage of the total deposits, the net demand and time liabilities, NDT deposits. That SLR requirement is a percentage of it, maybe 19.5 or 19, I don't remember the exact number, of the total deposits are to be held in the form of eligible government securities. Central government securities, state government securities, or some government-owned organizations which have issued bonds, etc. So they are SLR eligible securities. The bank has to invest. Fine, that's one. That means that becomes a starting point. But you remember the treasurer's objective is to optimize the revenue. So here is, let us say, the bank's total deposit is 1,000 crores. So say 200 crores has been invested in government securities. That becomes a sort of starting raw material for the treasurer. It is not that those 200 crore securities are invested and kept as such in the briefcase and locked, or it is in the demat account and kept as such and all. Treasurer can churn it, can change the composition so that to optimize the yield. Because remember, all those securities are tradable. That means there is a price. That means it fluctuates. Apart from the yield, which is already embedded or taken into account while quoting the price fluctuates. So I would like to purchase those securities which are cheaper at 11 o'clock in the morning. I would like to sell some of them at 12 o'clock. At 1 o'clock, I buy something else. I mean, these are examples. It's not that 1 hourly interval anybody does like that and all. So that means continuous churning is possible. It is at the end of the day, when I complete it, I should necessarily have that 20% securities. Those are all eligible securities. Very good. There is one particular government securities which is too much in demand, but I know that by another 1 hour, demand will come down. So at this point of time, I sell it. After some time, I buy some other eligible government security because that is also eligible. Because I expect that to appreciate tomorrow. I try to make money out of it, money out of the appreciation. So SLR requirement becomes a sort of important starting point for a treasurer. It's not that as a treasurer of a bank. It's not that a bank has to borrow funds or have some fresh funds and start investing or lending. There is already a raw material in the form of government securities. It can be churned to make it start as a treasury activity. I mean, this one thing, a simple example. There are many other methods in which it can be, there can be repo activity, reverse repo, etc., etc. The government securities used to give a low yield earlier. It was, government as sort of forceful borrower, in the sense, government issues securities at so low rate of interest, and the banks have to necessarily buy because of the SLR requirement. But last 3-4 decades, it's not the case. Government is borrowing almost at the commercial rate of interest. So it becomes even the yield is good. So you can make the banks are not so hesitant as it used to be earlier. Government borrowings are so. What is not a government borrowing? Basically, issuing government securities is nothing but borrowing. Those borrowings to the extent of 20% requirement, banks are sort of willing subscribers or getting it that. Surplus funds or tight money conditions of the market also requires a treasurer to manage. If I, for example, you as chartered accountant, you will understand if I tell these dates, you think about September 15th, you think about December 15th, you think about March 15th. I think these dates will immediately strike to you that these are the dates on which advance tax is paid. What does it mean? On those dates, lot of funds move from the corporates accounts with the banks. It goes to income tax department's account with the Reserve Bank. So it means the banking liquidity comes down. There's a tight money condition happening on those days. It is not that suddenly on those days happens, because already we know that on that day, approximately so much of crores of money will go out of the banking system to the Reserve Bank. It go out of the banking system. Liquidity will therefore come down. That means the call money rate will go up. So I will try to make profit out of it. Like expected share price increase, like the expected increase in the price of liquidity. Call money is nothing but that. Increase in the price of liquidity. I try to make profit. Maybe, I have surplus or I borrow in advance and then lend at this high rate, etc., etc. Like a typical trading. So surplus funds or tight, it can happen. Or it may be that, on some lean season, for example, there are no activities happening at all. No companies are starting any business. During, for example, the last 2 COVID years, the business activity, business growth was very less. Nobody was starting a new business. So the funds requirement was less. Banks were flush with funds, which is not the case now. You will see next year, for example, the liquidity will be still horrible. Right now, already surplus has become zero, negative. Next, it will, because corporates are investing. You go, every day you hear a lot of large investments taking place and all. FDIs, investment companies are moving from China to here. Remember, when somebody is investing from, that TSMC is moving from, let us say, $10 billion, or those so companies putting up a chips factory, etc. There are large investments. Banks are not going to lend them directly because too large an amount. But remember, each of such activities will have several ancillary activity business, which all require bank support. They take funds from the bank, and the bank liquidity will go off. There are a lot of funds committed, a lot of investments we are hearing, and they will happen next year. When it happens, it immediately impacts the liquidity. So when there is that tight money conditions, 2 years we had a surplus funds position. It was a no tight money. Now tight money, as we have started seeing, it will start seeing. That is why the rate of interest will go up. Apart from inflation effect, even the liquidity angle itself, interest rate may go up also. So these are all possibilities. But now you visualize, if you are the treasurer of an organization which has some 500 crores or 1,000 crores or $100 million of funds, either on a borrowing side or on a surplus side, you know how it is. Think of a situation like this. If you are the treasurer of a software company, which has got, say, let us say 1,000 crore surplus funds. If you go on leave for 1 day, and if you are there as 800 crores are in current account that day, or it was the previous day deposit has matured, you are not yet given instruction what to do with that, and you are on leave on that day. Remember, what will be the potential loss of revenue? You don't feel like taking leave at all. That is a responsibility you will have. I'm not saying, it's a lighter side I'm saying, but this is a serious process of the treasurer. The treasurer's activity, particularly in an active bank like that, when you sit as a treasurer of a bank, your activities are very similar to the person who is sitting in that air traffic control of the busy airport. So much of funds planes are coming, some planes are going off, you have to control, no accident takes place and all. Similarly, here as a bank treasurer, I know some borrowings are maturing, rate of interest coming down, I want to borrow it, I want this currency is appreciating, I invest, etc., etc. I have a tough team of people, but then I have to manage all of them. Each of them is a treasurer. I am the chief treasurer, but then every moment is precious. Tell you at busy time, a treasurer may not even go to a washroom. It's so busy. Think of a situation, air traffic control. Can he say that, no, all planes stand there, I'm going to washroom? It can't. It is continuous movement. The tension building up has to be extremely high. That is why most treasurers are very young, very good in tension bearing ability, and the burnout is very high, and there are no old dealers at all. Because they burn out and they go to the other part of treasury, not in the front dealing room, that part. So this is a treasury requirement in a bank. With this, there is what is called as a banking books and trading books, which words may be of interest to you people, finance people. It is not books means in the accounting books. There are no separate books maintained by the banks, one for banking and trading. What is not the banking books? The traditional banking activity, like for example, accepting deposits, giving loans, which happen at the branches. All those books, if you consolidate, it becomes what is called as a banking book. Notionally consolidating. Actual consolidation does not happen, don't worry. But on the other hand, what happens in the trading room, it's always buying and selling, that activities are part of what is called trading books. The treasurer buys, sells, borrows, lends in the interbank market or in the intercorporate market of a corporate treasurer, etc., etc. There are different segments for that. But those activities are, if you can consolidate their activities and draw a separate books of accounts, that are called as a trading books, just notionally. So trading books and banking books together becomes the total of financial statement of the bank. Obviously, bank does not draw books like that, but then as treasurer, we should visualize what is my contribution. It so happens if you can visualize, during the last 2 years, when the market was dull because there are no activities taking place, banking books did not grow much. All the funds moved to trading book because there are surplus funds. Traders had to invest to maximize the return, etc., etc. The size of the trading books was much higher, or its percentage in the total financial statement of the bank was higher during whenever the financial market activities are dull. So that's the broad principle or broad idea we should bear in mind. Anyway, this was broad understanding, trading books and banking books. But these are not my words. These are the words accepted in the industry, but not legally. It's not a part of the sort of accounting principles as such and all. I told you I will tell you about something about the risk in the bank. So this is a broad chart. And for your information, I'm sending this PPT to Institute in case anybody finds this PPT anything useful, you can ask, or I don't know what is the procedure, because there is nothing proprietary or confidential. You can write. This chart could be useful to you. Credit risk, market risk, and operational risk are the three types of risks which a financial risk is divided. Forget the bank, business risk, that is separate. We are not into that. The growth of textile industry or etc. That's a business risk. My competitor coming and my business coming down. But within the financial activity, which is relevant for a treasurer, the back risks are into the categories, three categories: credit risk, market risk, and operational risk. What is the credit risk? You understand. The counterparty risk. I give a loan and the borrower does not repay on terms as per scheduled terms, or either amount less or not on due date. This is all credit risk. Market risk is, this is what is important for a treasurer. Market risk is exclusively of the treasurer's problem, or treasurer has the challenge. Market risk means risk arising on account of the fluctuation in the market parameters. Interest rate fluctuating, the foreign exchange rate fluctuating, equity price fluctuating, commodity price fluctuating, etc. Commodity price and hence the warehouse receipt price are fluctuating. Those are all the basic parameters in those markets, the equity price or debenture price, etc., etc. Those fluctuations are not within the control of anybody. For example, I say, if you have kept a deposit last year for 3 years, and if the interest rate has gone up now, you feel sad about it unless you are able to take it before maturity and reinvest it. But was it under your control? Obviously not. Market interest rate increased. You had no idea. Even if you are the best brainy person, perhaps you could not have visualized it, or even if you are able to visualize it, not able to take advantage of it. Market risk is usually something outside the control of the organization. But we should be prepared for that, and that preparation has to be done by the treasurer. Operational risk, of course, everybody knows, it happens across everywhere. Staff dishonesty, system failure, there is a reputation, some allegation taking place, some misbehavior, etc., etc. All types of, the computer made a problem, it collapsed sometimes, the system, etc., etc. All of them are operational risk, can happen in any organization. Market risk, there is a method called as, come to evaluation is to be done, value at risk. And there are a variety of ways to control or measure these types of risk. Credit rating can measure, control credit risk, etc. But then these are all part of the problems or challenges one has to live with them. If there is no risk, when you see all that, you feel like, there should be a risk-free field, risk-free market. But please remember that if the risk is absolutely zero, the reward is absolutely zero. So that is not what we are. We are trying to minimize the risk and maximize the reward. That is what a treasury management is. So for that, we should understand what is a risk. And so these are the basic risks, which financial risk. If you are anything anywhere connected with, for example, bank, NBFC, insurance company, mutual fund company, provident fund company, etc., 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 these risks are essential part to be managed. Which types of organization there can be treasury? We talked about a bank treasury, etc. Bank is one, obviously we agree with that. The government also has a treasury. Earlier, but the government treasury is mainly to collect revenue and not much of it. It does not deploy. If there is a government which could have surplus, maybe it will invest through the central bank of the country, etc. It normally does not. There are some state governments, for example, if they have surplus, they may start a new organization, new company, wholly owned by the government, to which it gives a surplus, saying that, okay, you start doing something, this activity and finance activity, etc. But very remote. Most governments always are in shortage of funds. So obviously there is a question of raising funds. There are laid down laws, bills, your Fiscal Responsibility Act, etc., which controls. There is not much activity. If you are a very dynamic treasurer, obviously you don't feel like joining a government treasury as such. Corporates, yes, as I mentioned earlier, by now you realize many corporates have treasuries. In fact, the number of corporates who are having treasury as on date is more than the number of banks having a number of banks. If there are 120 banks, there are 120 treasuries. But the number of corporates having treasuries is much more than that now, which was not the case some decades ago, but which is the case now. Mutual funds, yes, obviously, because mutual funds they collect money, they have surplus funds, they have to grow the funds, they have to get the yield out of it, optimize the revenue without compromising on the risk, so that they are able to satisfy the investors. Insurance company, similar situation, lot of money comes in the form of premium, they goes out later in the form of claims. The going out in case of an insurance company is not very methodic, But over a period of time, you are able to study the time, sort of behavioral pattern of the claims. It's not that all people die on a single day, unless there is a calamity, etc. Pardon me for using these blunt words, but then just to visualize it, it doesn't happen. So that means there is a pattern in the form of claims going also, approximately what is the percentage, etc. So that means if you have a premium surplus, you know for what period it can be invested so that it can meet the liquidity requirement for claim payment. So for that period, how to invest? That's what the insurance company treasurer's job would be. Pension funds, similarly, for example, you collect employees, and then earlier this problem was not there. There was only government pension fund, but there are now private. And the private in the sense, many banks have started pension fund management companies, or managing the funds of the pension funds, act as a pension fund manager. That is why there is a separate regulator for pension fund authority as a regulator for all these pension fund funds owners. Just as a very casually, because we have been talking too much. So just to give a lighter side of it, not true, just to relax your mind. In an insurance company, the treasurer will wish, hope that all people live permanently, 100,000 years, etc. Because then what happens is insurance company, there is no outflow at all. So liquidity management because of that is easier. In a pension fund, it is not the case. The pension fund manager, because his job is to continuously pay the person till the person is alive. So his thought now is to reduce his outflow. His thought is, you know what it is, exactly opposite of what insurance. It may not be true, but there is a joke what treasurer, some joke goes within the treasury circle. NBFCs, non-bank finance companies, there are lots of them. There are specialized NBFCs and specialized, for example, housing loan finance companies, gold finance companies, etc. And all of them, or most of them, because there is a lot of restriction that has been imposed on them for raising funds from the public. They go for wholesale borrowing in the market, the different segments of market. So the main challenge for the treasurer in this NBFC, specialized NBFC, will be to raise funds at an acceptable cost. So if there is a treasurer who was working in, say, insurance company or a pension fund, if he resigns and joins a specialized NBFC, his task will be exactly opposite. Because earlier his task, my job was to deploy for optimizing the return revenue. Here it will be minimizing the cost. Just as an example, to make the picture clear, I'm telling that. High net worth individuals, yes, many of them have started, all these startup company owners or software companies who started, the owners or the founders of these such types of companies. They have a large surplus either on account of the preferential allotment of shares, or their initial investment has grown so well, etc. And part of it they have monetized. So their surplus available for managing is actually much higher than some of the smaller banks, some of the private sector or cooperative banks. So that means they can't manage on their own. So they have set up what is called as a family office, where the treasury, there is a treasurer whose job is to invest and then optimize the return without compromising on the security. Without compromising on the risk. So this is again another activity one has to. So this is scope for that. Of course, high end you, yes, I told you, we also behave like a treasurer at some points of time. While to put your money in fixed deposit for 1 year, 2 year, 3 year, etc. If I start thinking it is a treasury activity, if I think about floating rate or fixed rate, etc. for availing a home loan, that is a treasury activity. So many such decisions we do it without calling ourselves a treasurer. But this is what the treasury activity is basically. Again, at that time, even if the interest rate is high in a cooperative bank, I think twice whether to invest there or not. Because the risk management also I'm doing along with optimizing revenue. Then I decide, okay, I've got so much of money. I will take a small percentage, let us say 0.5%, I'll put it in this cooperative bank because the yield is good. By chance, if the bank does not repay me, all right, I am able to absorb. That means it is within my risk appetite. This is what the risk management part will be. What are the expectations out of treasury? I think by now we are very familiar with that. High yield on surplus, low cost funds availability, that too in time, and risk within acceptable level. Same thing what I said earlier, put it in different words. Risk management policy of the organization, which is not decided by the treasurer on an ad hoc basis. A requirement is, for example, in all regulated entities, banks, NBFC, etc., in all regulated entities, before starting the treasury, a risk management policy has to be documented, kept well maintained. It can be as detailed as possible so that it is in place, because that will give the sort of floor and cap for the treasury activity. It is not left to the discretion of the treasurer. What the owner or the higher management or top management has in mind can't be communicated orally. It has to be documented. That documentation results in the document called risk management policy. In fact, at this point of time, for the participants, a request, in case you are not working in a treasury, but if you are working in an organization which is a part of treasury, which has a treasury, like bank, NBFC, etc., as I said, or even a corporate, because you are a part of the same organization, I request, please make an attempt to get a copy of it, and so that you can go through it. Because it may not be officially available. Okay, you say that one day I will come to your treasury and sit there itself. I will not even bring my mobile to take photocopy. I'll just read it and go back. Maybe a couple of hours you are reading, and perhaps it will give. The complete picture you will get when you read the document is much more valuable than listening to me for 2 hours or reading a book of 500 pages. Because that's a real practical distilled document which tells all about what we talk about. Think of, please try, because if you are already in a treasury, of course, you have a right to do. If you are auditing a treasury of an organization, you have every right to go through the document. I mean, obviously not for copying, but you have right. You don't get many active risk management policy documents in the internet. It's not an open document. It's very confidential. That's why I said, even in the organization, in your own organization, you may not get it that easily if you are not a part of treasury, because it tells about its philosophy of the organization. You get a very clear risk picture of the company by reading it, So try to get a copy, or try to read a copy of it, not get a copy, read a copy of the risk management policy. It will be useful to you. Understand? The expectation of treasury, particularly for a finance organization, bank, NBFC, etc., is what is called as ALM, or asset liability management. It's not AML, anti-money laundering. No, forget about it. It's the ALM, asset liability management. What's on to asset liability management? Managing the assets and liabilities. What is on to managing the assets and liabilities? In 3 aspects. One is, as far as the maturity is concerned. If a bank is having all deposits for 1 year, if an NBFC has borrowed funds for 1 year, if the bank or NBFC has lent to customers for 5 years, we have an issue, because those who have lent, like for example, the depositors of the bank, if all of them come together and decide at the end of the 1 year that, okay, sorry, I am taking back all my money, the company or the bank has got a problem, because its money is not inside its chest. It's not in its currency chest. It's not inside its building. It's not in the account to the Reserve Bank. It has been lent to customers. And customer has started a business, and you can't liquidate the company and business and then give back the money immediately. That means you have a liquidity mismatch problem because of the duration of the deposit, or duration of the borrowing, and duration of the its assets. So asset liability management, as far as the maturity is concerned, is one aspect. Asset liability management, as far as the interest rate is concerned. If a bank has accepted all deposits at fixed rate of interest of say 8%, hypothetically, if it has lent to customers at say floating rate of interest, and if the interest rate comes down in the market, then the bank's margin will squeeze. It could even become negative. So that means interest rate managing. It's not that every deposit is managed with the mapped to a loan. Average deposit, average interest rate, or those assets and liabilities, or which are maturing or which are falling within a particular interest rate bucket, matching, etc. There are scientific methods of managing ALM, but that is a part of the responsibility of the treasurer. Whether it can happen even in a corporate. Corporate has a surplus. It has invested the money in commercial papers in the market, which is not getting traded well, or even if it is getting traded, if I sell it today, the price is very low. If I can wait for 15 days, it will go up. But the management says, I want the funds tomorrow. We have a problem there. Similarly, interest rate. All these was both the situations. The maturity management, the interest rate management can happen banks, finance organizations, and also corporates. Third is about the currency. Think about a situation like this. Let us say there is a bank in Kerala whose 90% of the deposits are FCNR deposits. That means deposits are in dollars. But it does not lend in dollars because there are not many customers who take money in dollars. They are all domestic customers. They borrow in rupee, etc. So you could have a problem because dollar appreciates, your returning could be a problem because you have converted the dollar into rupee for the purpose of lending to these customers. You are an NBFC, you are a corporate. What you have done is, as your surplus you have lent, you have had a surplus. You have a surplus in the form of raising ADR, GDR. No question. And you want to invest it in, say, for example, into a subsidiary. But then that subsidiary is coming up after 1 year. So, all right, why to keep the funds there itself? You are raised already. So, convert it into rupee. After 1 year, you can give it to the subsidiary to start of the borrowed ECB money or ADR, GDR money. So that during the 1 year, I can use it in India for my corporate business because otherwise I'm borrowing at 10% from the bank. All right, very good decision. You reduced your interest cost. But by the time when your subsidiary comes up and you convert, if the dollar is much costlier than when you convert a dollar into rupee, you could have an exchange risk. So your assets and liabilities, receivables and payables were in two different currencies. That is why the risk came. You have a company, you are importing a lot of raw material. They are all imported in euro. All your exports are in dollar. You have a risk management. Even though the amounts are matching, you have a problem basically because you have a dollar-euro exchange risk. So the ALM or asset liability management, assets and liability managing should happen as far as the maturity is concerned, should be managed as far as the maturity is concerned, interest rates are concerned, and currency is concerned. Currency generally does not become a serious issue. Maturity and interest rates become serious issues for finance organizations. If there is a maturity mismatch too severe, it results in liquidity problem, huge reputational problem, run on the organization or the NBFC, and it could lead into a liquidation situation. Liquidity management is extremely serious. Or I'm sorry, asset liability management as far as the maturity is concerned, very serious. The first one. Interest rate, if there is a wrong ratio, fixed rate, floating rate, mismatch, etc., etc. Yes, it results in, it affects the profitability. Profit could become loss in the long term. Perhaps the company may find it difficult to survive. But the immediate risk may not be there on account of that. We can visualize. Liquidity risk is much more serious. This is slightly less serious because we have time to breathe and manage. Even though there is a loss happened, maybe you can regain and recoup the loss. Third one, currency mismatch happening. Of course, not many situations, less number of situations. But these are the broad areas of what we call it asset liability management, which is a responsibility of the treasurer when the management expects the treasurer to handle this. Regulatory compliance, for example, maintaining SLR, submission statements, currency mismatch, borrowing in what currency, etc., whether that is allowed. Reserve raising capital, SEBI guidelines are to be followed. All of them are responsibility of the treasury. Regulatory compliance is a responsibility of the treasurer. Then, of course, if you are the expectation, if you are in a corporate treasury, maintaining good relations with the lenders, other stakeholders, there is also a responsibility of the treasurer. As I said, in the bank, of course, there is a separate department. What are the features of a treasury? This is what so far we understood all about the the overview of it, the situation of how it arises. What are the features? What actually happens? The buy and sell, the borrow and lend, etc. The volumes are very large. Number of transactions is very limited. Therefore, the number, for example, it may so happen that there may be a bank where the profit on account of a treasury in a particular year, maybe nearly 50% of the profit on account of the borrowing and lending, the banking books and trading books. Trading book profit may be half of the banking book profit. But this is managed by all those branch managers. There are 150 branch managers and some 5-10 staff member each. So number of staff is very high. Whereas in treasury, front office, back office, mid office together, there may be hardly, let us say, 100 people. The productivity, therefore, is much, much higher in a bank. So that is why treasurers always think that they have two horns. They talk in terms of the first person singular. I lent $100 million and made so much of profit. One true in a sense, branch manager cannot lend 100 crores on his own in 5 minutes or 2 minutes. But there is a lot of approval, note, etc., and all. So it is subject to a lot of procedural aspects. Treasury, that's why, which also means the treasurer has to be extremely good. Otherwise, it could lead to a large profit or it could lead to a large loss. Limited number of transactions, high productivity, obviously high risk. Risk and reward movement, I think all of you know about it, goes together. Here, the idea is we want to separate it and say that risk is low and reward is high, which is a bit difficult, but that is what the efficiency of a treasurer is. how much time I have? I think I'm expected to close by around 6:40, 45 or so, because I also want a lot of questions to answer. But that means we have approximately another 30, 40 minutes. So that's, I think that should go. High reflex, therefore, okay, in Treasury, there are basically 2-3 sorts of departments. One is called the front office, where they buy, sell, very quickly. So the reflex has to be very high. Their tension bearing ability has to be very high, etc., etc. They are the people who are that is why it is called front office, because it's not that they are sitting at the edge of the building. Because they are the front as far as the other party is concerned. The counterparty is concerned, another bank, another corporate, or another NBFC. This person is the face of the bank, or the face of the organization. It's a front. That's why it's called front office. There is a back office which handle a lot of accounting, settlement, payment, etc., and all. So there is a mid office which lays down the policies, very broadly speaking. So the front office people have a high risk, high reflex should have, and tension bearing ability is very high, etc. If you can visualize that. In fact, if you put it in Google, you get a couple of dealing room YouTube videos. Credit Suisse or a couple of the bank, BNP Bank National Pari. So their videos are there. You can see it. It's a bit funny. It gives good idea about how exactly it happens. Just 1 minute. I think charges. Yeah, that gives an idea about it. If you are interested, go through it. It is quite interesting. It's just 5-10 minutes. A couple of videos are available on the internet. That tells how exactly, for example, he's talking over phone and simultaneously eating sandwich or talking to somebody else, etc. That multitasking activity and quick decision taking, etc. Organization is a front, back office, and mid office. Front office, all these traders, etc., who buy, sell, etc. The back office, accounting, settlements, interest claims. If you are an auditor of a treasurer, in all probability, you'll sit in the back office because all documents are available at the back office. No, most of the time. You will always sit in front office just to see what is going on and perhaps whether they are capturing the information is correct, etc. But major time, because all the documents will be available at back office. Mid office is sort of an extended arm of the management, top management. This is where the policy is laid down. What should be the counterparty limit for this bank, or what should be our policy for this currency? What should be our long-range interest rate view, so that traders can play within that. There is a broader risk management policy laid down by the management. Within that, day-to-day sort of the limits, etc., are set by the mid office, subject to, of course, approval from the top management. But then it is decided, and if it's necessary, it is changed. For example, there is some wrong news happening, some bad news about a particular bank. Immediately, even though there is so much of limit laid down a few months ago by the board, maybe today itself you will reduce it, then subsequently inform the board saying that for the ABCD reasons we did like this and all. So it comes into picture immediately when required. Such crisis management when on an instantaneous basis is done. But otherwise, it's sort of broader policy laying guideline. Usually these policies are changed once in a year, unless of course there are some rapid changes on a particular day or during a season about the finance activities or interest rate or some currencies or some counterparties, etc. How should the staffing be? There is no answer for this, but now you will visualize that if there is a person who is very young, who can take a lot of tension, he has a trading sentiment. That means he has a trading sense. He is good in buying something at a low cost and buying. Broadly speaking, somebody who is good in negotiation, who bargains a lot, who knows where to buy something cheap, etc. Those type of that sense coming into picture, they perhaps may fit into a front office, not necessarily a thumb rule, but broadly. Somebody who is mature enough and who is good in looking at the errors, who can spot errors easily, who has a sense for what can go wrong, what are the weak points, etc. Who is very good in documentation, etc. They could be part of back office. Somebody who has a vision for the long range on the economy, on the currency, global geopolitical situations, etc., or the currencies, inflation situation, etc. Could be part of mid office. This is a broad guideline. Think of it where you fit in from this description. And mind you, in addition to these three, there is a great scope for you becoming an auditor. The auditor of a treasury, because that requires more of the sense of back and mid office, not much of that front office. That quick reaction time is not required. There are situations where you have to do, for example, in banks, there is also what is called as a concurrent audit of Treasury is a mandatory thing. Like that, there are different situations. So auditor can fit into with a lot of these traits, with a lot of these competencies. Auditor can fit in many of these situations. Auditor can handle a lot of such situation work. Treasury, when there is a need for a treasury, a separate unit, I think we already discussed when there is a depth and diversity. Amounts are large, but more important than the size of the company, whether it has a multiple, whether it's diversified its borrowing lending activities, whether it in currencies, multi-maturity, etc., etc. What is the depth? For example, what type of complications is arising, etc. So then it is justified. Otherwise, perhaps it may not be justified at all. So what are the choices for availing raising fund? Just for maybe a broad understanding. Equity can be raised in India in Indian INR. All of you know about it. There are different types of instruments like equity, debentures, a combination of that. There are what are called as, what is it? Some funny words come. Fixed interest rate equities, fixed yield equity, something like that. Equity by nature, by definition, can't be, but some combination can be done. A lot of private equities are based on that principle. Private equities, even though it's called equity, it may not strictly as a concept, as a philosophy, it is not an equity. Equity can be raised in the form of abroad, in the form of ADR, GDR, American Deposit Receipt, Global Deposit Receipt, etc. Or somebody can invest directly into our organization called as an FDI. It can be any of these or a combination of that. There can be debt. How to raise debt? What are the instruments available for raising? In the form of debt. It can be banks and other institutions that all of us know. It's a traditional one. Commercial papers and other money market instruments for raising funds. Debentures, bonds, etc. It could be in Indian rupee or a foreign currency. It could be trade credits. What's into trade credit? Buyer's credit or supplier's credit. I think all of you, if you are working in an organization having import-export, you know about it. I am exporting goods on a 90 days basis, usance. Then basically it is supplier credit. I am exporting on a 180 days basis, but I want the funds immediately. So what I do is I tell my bank, so and so in London is the buyer. Is it possible that you organize something so that, some bank will finance this person for 180 days so that I get the money immediately? That means somebody is arranging a credit directly to the buyer. A third party, a bank abroad is arranging directly to the buyer so that out of that loan, I get paid off immediately. So my 180 days usance bill effectively becomes a site bill for me. But 180 days usance bill is a usance, 180 days usance as far as the buyer is concerned. So who is coming into the picture? A lender in a third country or in the buyer's country who finances. It could be both on export. I gave the example of export. Absolutely similar picture for imports. There can be external commercial borrowing. These credits are related to import of goods. I gave a wrong example of an exporter. So buyer's credit and supplier's credit from that country, the buyer's angle. So an importer, for example, I am importing on a 182 basis. My supplier wants immediately. I am not able to lend it, so pay immediately. So I still avail the 180 days credit, but buyer gets funds because somebody in some bank in a third country finances for the 180 days. Finances on what basis? Because my bank has issued a LC or a guarantee. Based on that, which is a much better acceptable risk, credit risk for that bank rather than my signature as on a bill of exchange. So the buyer gets the funds immediately. I get credit for 182 days, and third party bank provides the funds. So all people become happy. They meet to the term. That's a buyer's credit. Supplier's credit, I directly supplying or I importing directly on 182 day basis, and the supplier giving me the credit. ECB external commercial borrowing is not related to import, but you I think know about it. It's basically a loan being availed in foreign currency from an acceptable lender outside India, not from some third party or unknown faltu party. There are some regulator has laid down guidelines. So I think when you get into ECB, you know about it. There are also what are called masala bond. That means basically issuing loans where exchange risk is not there. Because in ECB, the main problem is I as a borrower, I have an exchange risk. But if I'm able to raise my loans in Indian rupee, yes, I am ready. But if there is a lender who is acceptable, who is ready to lend and hold the receivable in the currency called INR, then it becomes a masala bond, because then I don't have an exchange risk. Exchange risk with the lender. It is becoming slowly popular, basically because if masala bonds become popular, Japan issues a lot of such bonds. They have got their own sushi bonds, etc. There are different names. Masala bonds, if it becomes popular, it becomes acceptable, it means INR is acceptable internationally. That's a basic idea. The basic idea is, basic indicator is, if masala bond is familiar, it's become popular because INR is acceptable worldwide. Slowly, remember, now a few months back, India RBI said exporters can invoice in INR also. Earlier, it used to be INR in convertible currencies. Now it can be accepted in INR export invoicing is allowed. If the buyer is ready to accept the bill, for him import bill, my export bill, which means INR is now becoming acceptable to him. So it is what is called as a internationalization is taking place. It's all good, but as a treasurer, my problem is much more. I have diversified something more. I have one more instrument to handle. It's not a problem. Rather, I used the wrong word. I have my challenge has increased by one more. I should be familiar with one more instrument. I should be familiar to the extent of using it and taking advantage of it. That's what the expectations of the treasurer will increase. This is for raising funds. What are the choices available for deploying funds? In India, banks, CDs, certificate of deposit, money market instruments, etc. Mutual funds, other financial intermediaries. It can be INR, foreign currency, etc. I think you know about it. Then deploying surplus funds. But this arises mainly, for example, software companies. Most of them have surplus rather than borrowing. So their treasurers all have this problem. Can we invest in this, CP, CD, etc., etc. Outside India, investing in some joint ventures, overseas direct investment, if that is my idea of my company. If the software company is acquiring another software company, it is setting up of a subsidiary in another company, etc., then it becomes an overseas direct investment. Or it could be investment in the secondary market, in the stock market itself, can be through LRS, liberalized remittance scheme, routed investments. There is a ceiling of $250,000 per year, financial year, etc. But then there is one route, even individuals, for individuals it's available. For organizations, there are limits. For example, mutual fund, I think there is a limit of $7 billion, even though they may not invest like that. So there are ceilings available up to which corporates, finance companies, financial intermediaries, individuals can invest abroad also. ODI also subject to direct without permission, with permission, ceilings on the amount. There are conditions, but these are the sources by which you can raise funds or you can deploy funds. Why deploy funds choices? Because one of the objectives or requirement for me as a treasurer is optimizing the yield. Why I look at this raising funds choices? Because minimizing the cost is my choice, is my required expectation. So depending on where I am, raising funds or deploying funds, I should be familiar with all these instruments so that I optimize and meet my objectives. My KRA will be satisfied, rather my appraisal will be good. I mean, it's a jocular part, but then, the organization objective is met. That is an objective, there is an expectation out of the treasurer. What are the challenges for treasurer? The large volume, high transaction, I already mentioned. Profit or loss could be very high. Working under pressure. Live wire. I think we mentioned all this. We discussed volatile markets, regulatory guidelines. It could be varied. It could be dynamic, changing from time to time. It is a bit complex in the sense, it is not that it's not a one line or one page guideline. It could be running into hundreds of pages. You have to follow that for ODI, ECB, for everything. There are detailed guidelines. Because there are some borrowers who there are some entities who misused it. So the guidelines have become more and more lengthy, detailed. There are very granular details available. So one has to be careful about it. Regulatory compliance is not that easy as clear. Technology has impacted it substantially. I will come to it. That fintech is one example of that technology. What is fintech? Basically, application of finance technology in financial activities. It has eased the life to some extent. It has also increased the competition. So fintech companies, instead of being collaborators, it could be competitors. For the final user, it would be good. But for as a treasurer of an organization, it could be a challenge for you. But then these are all the issues one has to live with that. Because after all, it's an evolving situation. So managing the treasury management is covering all this. This is what a treasury management is. There are a lot of controls, basically, because in case of regulated entities, banks, NBFCs, insurance companies, provident fund companies, mutual funds, etc., etc. In all of them, the regulators have issued detailed guidelines. They are on the organization structure control, risk management policy has to be laid down. There's on the document, in the form of a document. The powers have been delegated to the traders, sub-trader, dealers, sub-dealers, junior dealers, etc. Both on the limits and in measuring efficiency. There are guidelines, or at least guidelines have to be written down in clear terms so that the dynamism exercised by the trader does not become sort of adventurism. That's the basic idea. Reporting requirements, both internally and to the regulators, procedural control, RBI guidelines on internal control, particularly for banks, FEDI guidelines for banks, that is Foreign Exchange Dealer Association guidelines for banks, code of conduct similarly for banks, for FEDI, and also for some of the non-banking companies by FIMDA, that is a Fixed Income Money Market Dealers Association. So those are all the activities which control, for example, investments or activities in foreign exchange, money market, etc. These are some of the, or these are most of these control activities are, these are consolidated list of that. There are opportunities, I think, in treasury function, because what are the drivers we discussed about liberalization, globalization has happened. By establishing a treasury, what can happen? Obviously, the optimizing the yield or minimizing the cost can happen within the acceptable risk. What are the opportunities in the treasury as a dealer, front office, back office, handling accounting, documentation, etc. Mid office as a policymaker, as a consultant, you could, in the form of currency, advisors, interest rate, foreign currency, etc. Investment, borrowing, etc. As an auditor, as a compliance officer for RBI, SEBI guidelines, asset liability management, taxation, for all these compliance officers, they are required, or at least they are mostly the part of the treasury. Every liberalization, every control, what happens is now that there are variety of, lot of powers have been delegated to the financial intermediaries, the regulator can't check these individually. So what the regulator does is, with every delegation, every liberalization, regulator says, get an independent confirmation from an independent finance professional. What they mean is by a chartered accountant, maybe a statutory auditor or a chartered accountant. So the role of a finance professional, accredited finance professional like a chartered accountant, has substantially increased. More liberalization, more requirement for certification, more requirement for the auditors or the chartered accountants to get involved. From concurrent audit for every transaction angle to annual audit. So all that, it happens across the tenure. As a marketing professional of treasury products, there are a lot of opportunities available. Because the diversified products are more now, have their own complication, it requires somebody to explain to the end user. So finance professionals have come. There are regular SEBI examinations also conducted so that one becomes a really good finance professional and all. It could be in India, outside India, there are finance centers coming up. Financial center within India, like the Gift City, etc. That again is an opportunity where a lot of treasury activities taking place. With financial intermediaries, corporates, high net worth individuals. So the scope or the vacancy available, so-called, is sort of opportunity available or at across all sort of entities. This is, for example, there is one example, increased role of CAs under liberalized export process. This is my article. There is a post called, I think a couple of articles are there, not recently, but the finance post and all. Because this is I have given an example, how in an export transaction, earlier, what are the situations where a regulator, where an auditor was involved or required, now how much of a corporate entity situation and all. This is open available, financepost.in. If you are interested, you can look at it. There are interesting articles. In fact, it is by a couple of chartered accountants based in Mumbai. If you're top management, therefore, if you are the owner of the top management or the owner or top management, you will need when will you find the need of a treasury or why? I think we discussed it. What do you expect from the treasury also? I think we broadly discussed this. Risk and reward, look at treasuries to be recruited, what are the look, etc. These are some of the broad questions we discussed across the slides. I think it should be broadly clear to us now, by now. What is the impact of technology on this? I would like to spend some 5 minutes before we throw it open for question answers. Technology has impacted it substantially. How exactly? This is the general statement. Well, I give an example. There is a product called as CMS. Many of you may be familiar. Cash management services offered by banks. It was a great product around 2-3 decades ago. Now it has slowly died down. What it is? Basically collecting receivables and then giving an accounting part of it, making it available to increase the efficiency or your liquidity management improvement using the blocked receivables. Because checks were earlier, it used to be in the form of checks collection at the outstation centers, all that usual clearing sort of related challenges. Now most of them have gone out because large payments are invariably made through RTGS. So the movement of funds, there is no need to open collection account at different centers and pool the funds and transfer at the end of the day, keep some minimum balance there. All that is not there. You can have a central one account in the bank and then all funds get pooled at a real-time basis. So that means CMS becoming slightly less relevant than what it should be earlier. It could be a dying product. Lockbox is a dying product. Lockbox. What is lockbox? Like, for example, you keep a box locked and people can drop a check into that, like you will drop a check for your electricity payment or credit card payment, etc., or EMI payment, etc. All of them are gone. You can pay by electronic standing instructions. Easiest type of payment instruction can be given. So technology has made this sort of irrelevant products. Blockchain eliminates float. There is a blockchain technology. I'm not technically competent to explain, but basically what it means is it's a technology where different parties get involved so that the importer and exporter, if both of them are on the same platform, the payment can go through the bank in no time, or it can go directly in no time. The exporter's account get debited, importer's account get paid, etc. It can happen very quickly, but import-export situation or in a local bank situation, local sales situation also. If the users are on this blockchain technology, it eliminates the float. It's a good news for the corporate, but may not be good news for the bank. That's a different issue. Eradicate settlement processing time, errors in booking, and support real-time integration between finance. That means basically the buyer, seller, buyer's bank, seller's bank, all of them as if they are sitting across the table. The moment goods are shipped or it is agreed, if some advance payment is to be made, the seller says, the buyer says, okay, give $10,000. Tuck, the moment funds come here. Exporter says after some time, this is a bill of lading, I am giving it to my bank. Then immediately under the LC payment comes to the exporter. It can happen in no time, no delay, no discrepancy documents, waiting 5 working days, 7 working days, all those are not there. It can happen, real-time global integration can happen. It is still evolving, or perhaps in India, as far as India is concerned, it is not yet evolved because we have also some exchange control challenges involved in that. But then it is all in the offing. Remittances are much easier. SWIFT itself made the life easier, but then this is much faster even there. Because basically in SWIFT, what happens is it is between the two banks. The buyer and seller are behind. They are not a party to that MT 101, 102 or MT 700 for LC, etc. Between the banks, and then it comes here, it goes back, etc. Now in a blockchain technology, all the 4 are together on the same platform. So it becomes easier. Remittance becomes easier or instantaneous. There are multilateral nettings happening right now through organizations called as Clearing Corporation India or Continuous Linked Settlement on international level, etc. So those things become much easier. These intermediaries will lose their relevance, but then it can happen directly. Well, it will take time, but then that is what is possible. Implications on the counterpart risk, it becomes much easier because when the buyer and seller are selling, and the buyer is buying from the seller. Earlier, one hesitation, the seller feels, buyer may not pay, buyer feels that, goods, etc., etc. Now it is all across. So the moment he shows the documents, it can be paid. The moment some certificate, etc., is acceptable, it can be paid instantaneously. There is no delay involved at all. So that means the risk of one party failure does not arise if this works perfectly. If you have heard about what is called as the smart contracts, this becomes a smart contract. If something is done, then payment will happen. You put, say, 10 rupee note into that slot machine at the railway station, one chips packet comes out. That is actually a smart contract. So similarly here, I sell the goods and the bill of lading is here and the buyer pays. So it becomes as simple as that. The entire transaction becomes a smart contract. The volume can grow substantially. Challenges. This also leads to challenges. There are new types of digital assets that are come into the picture. You heard about Bitcoin. Remember, blockchain technology is fine. But one user of the blockchain technology is the Bitcoins. There's a lot of not so good news happening about it. I don't know whether you heard about what is called as FTX, a company which has some people talk about $20 billion, $10 billion, etc., which has collapsed just in November, almost second half of November or so. So there are issues. Reputational issues for the product called as Bitcoin. Non-fungible tokens, even the artworks, non-tangible assets could be converted into a physical paper, telling the owner, giving the ownership of that, so that it becomes a tradable entity. It becomes easier to trade. Well, of course, it is losing its charge. That's a different issue. CBDC, central bank digital currency, and also it has been introduced for at the wholesale level between banks, not at a retail, my and your level. But then over a period of time, that will become. But remember, now itself, bank treasurer has to be very familiar with rupee CBDC, e-rupee. So similarly, internationally, for example, if he is dealing with some other banks across the country, perhaps he has to be familiar even with that also. Bitcoin character makes it as a treasury holding. Regulatory clarity, the standard operating procedure, infrastructure required for this are all evolving. So it is all not the done thing. It is a work in progress. FTX collapse is bit jeopardizing the entire progress also. RBI and government views, if you have read newspaper, you would have seen RBI is not at all enthusiastic about Bitcoins, etc. Government was interested, of course, but then it has not done anything sort of specifically legally on that. Legislatively, nothing has happened at all. But this is the challenge which you have in the treasury. This is what the current trend is. That means if you are tomorrow joining as a treasurer, apart from your finance knowledge, please equip yourself adequately on the technological impact on that technological progress that is happening in the form of digital assets. There are a variety of digital assets coming to which a treasurer will get exposed or required to be exposed. For example, in that FTX collapse, it appears there are several Indian entities which have lost money. That means basically a lot of people have invested. That means basically a lot of investors have taken a treasury decision. It could be some corporate treasurer also. So these are the challenges which we have. This is what is evolving in the treasury market. I think with that I will end, because we can go on talking, but then number one, talking one unilateral one way talking is not good. Secondly, there is no end for such talking. So with that, I will wish to thank you very much. Thanks for patiently listening. Hopefully you are listening, and hopefully it has become useful. That's most important. At least some broad understanding has happened. Subject to that, I thank you. And of course, now we'll give the time for whatever limited time available for our questions. I ate away some 4 minutes of your time. So now it's over. I think Institute will organize how to get the questions and ask me. There could be two-way communication is always a challenge in meetings. But our Institute team is ready to receive questions and transmit to me. Thank you. What I will also do is
thank you, sir.
I will end this session. Share screen, so it becomes easier for full screen. Okay. Oh.
Yes, sir.
The shared window is closed. Yeah, go ahead. Now it's.
Yes, sir. So we received some query from the members.
Yeah,
the first one is,
yeah.
Sir, can Indian corporate take ECB for outbound investments?
Yes, that means the question, I will put it the other way. A corporate has taken a ECB loan. Can it use it for outward investment? Or can we raise a ECB loan almost exclusively for the purpose of outward investment, setting up of a subsidiary, a joint venture, etc.? Answer is yes. There are conditions. That's a different issue. But the answer is yes. Very clear yes. One of the permitted purposes is ODA. Okay. Next.
So what is an expansionary monetary policy and contractionary monetary policy? How they act as stimulus for the country?
How they?
Sir, how they act as stimulus for the country?
Stimulus for the country. Okay. What is expansionary and recessionary? Is it? What is that?
Yes, sir. Contractionary.
Contractionary, yeah. Basically, the monetary policy.
Sir.
What is into monetary policy? Basically, it is something about telling about the money market, how exactly we are going to control. That's what the broad monetary policy is. Reserve Bank announces it. But what we understand is Reserve Bank monetary policy, there is some change in repo rate of interest or interest rate, etc. That's what we broadly understand, because they are the instruments for controlling the liquidity in the market. That is a major aim of the monetary policy. Okay. Now, what happens is if there is a lot of tightness in the market, what is meant by tightness? Because funds are not available for lending, call money rate has gone up, the interest rates are very high, etc. If that is a situation, what can be done? Then what happens is all borrowers are crying, saying that I want to expand, but there is no money available, banks are not lending, I am not able to raise funds, etc. So what happens is then Reserve Bank may have to pump in liquidity so that it cools down. That's sort of expansionary monetary policy has to take place. How does that will happen? If Reserve Bank reduces the rate of interest, the reference rate of interest, repo rate of interest, or if Reserve Bank reduces the SLR, CRR, that is the money blocked by banks, then their ability to lend more will increase. So that is a sort of X. Then what happens is the banking size will increase. There is an expansion in the monetary activities. So that is an expansionary monetary policy. I think if I explain that, I need not explain the other one. Recessionary is exactly the mirror image of it. So there is too much of liquidity in the market, and and then all the pensioners are crying, and etc. happening. Then in fact, why? Okay, then you increase the rate of increase the rate of interest. You take out the money, increase the SLR, CRR, etc. So it becomes a contractionary monetary policy. How does it become stimulus? I think now visualize. What is stimulus? It is like something like giving a steroid, something like giving an antibiotic, so that the patient becomes quite active. Oh, my disease is gone. He starts jumping around. So for that, what is to be done? That is a stimulus to be given. So when the recessionary activity, if you can make it as normal, or if there is too much of expansionary activity, I try to cool down. That is a sort of stimulus for the economy to go in the right direction in which the central bank or reserve bank government wants. That's a stimulus. The change of the objective of the monetary policy is only nothing but stimulus. Controlling the rate of interest. By changing the rate of interest, it becomes stimulus. Yeah. Okay, next one.
The next one is how to improve Treasury's ability from transactional to strategic function.
How do the Treasury?
So Treasury ability from transactional to strategic
ability to
function.
move to transaction to policy. See,
Strategic
it's not ability to move from here. The transactional activities are handled by finance professional, finance department. So the policy are handled by Treasury department. In a small organization, so it may so happen that one person is handling both. When the organization grows, there may be two people, one handling transaction, another handling policy. When it grows so well, the Treasury handles that, it becomes a separate department as a policy and for the transactions. The evolving or ability, it is ability means basically if you are wiser, your head become more bald, you have a greater vision of the future. So your ability, you are not confined to the day-to-day transaction. You are confined to what will happen in the next month, next year, etc. That vision, when we get developed and when we use that vision in our decisions, in our policy decisions, it is basically a Treasury activity. I may be wearing a Treasury hat, I take it out and do a transaction. I take it out the transaction hat, wear the Treasury hat, take a decision. So that is what transaction and Treasury are there. It is not mathematically or legally separatable activities, but this is a broad idea or picture of their activities.
Right, sir.
Clear.
So the next query is, how can global banks support Treasury initiative in the age of digital business models?
How can the bank support digital activities in this digital transaction? It is not the banks which is a question relating to supporting Treasury digital activities in a corporate Treasury. See, if the question is relating to Treasury within the bank, there is no question of bank supporting. Bank has to really meet the challenge. On the other hand, if the question is relating to how the bank supports the digital activities or etc. at the bank, at the corporate Treasury, see, actually, frankly speaking, bank does not support the digital transformation of the corporate. That's for the corporate to take active initiative, because basically that is in time. There is no alternative, so it has to do. But what the bank does or supports in a way is, for example, bank also upgrades its Treasury correspondingly, so that the Treasury of the corporate, when it has moved into a higher technological level, bank is already at the same level. One simple example is, originally, that may help for the future. When originally SWIFT came, when through the remittances take place, etc., it was only between banks. But subsequently, a terminal of the SWIFT could be extended up to corporate. Not many corporates are taken. Then what happens is the bank that supports the corporate. Instead of giving an LC application by the corporate, it fills up in the SWIFT format, so that electronically it reaches the bank. Bank adds couple of corrections, couple of sentences, its own guarantees or covenants, and transmits it abroad. Now what happens usually, bank, if the customer gives a written LC application, bank goes through some filling up, some incompleteness, etc., takes time. This gets automatically transmitted. So the bank therefore supports the corporate's efforts to technologically improving by also meeting those requirements, being at the same level. That's what it will. But otherwise, as an initiative has to be necessarily taken by the corporate treasury for the electronic or the technological transformation.
Right, sir. So that's all. We received all these queries. Actually, you have taken the topic in detail. So I must say
Before that,
members got
sorry,
the benefit.
before that, would you like to give any 1 minute time for any open question at this point of time, or it's all questions are already collected?
Sir, questions are already collected. We
Okay,
received
fine.
the questions
Okay,
from.
okay, fine. Thank you. Okay, fine.
Yes, sir. So now we can conclude, sir. I want to say thank you. Thank you for taking this webinar and enhancing our knowledge and giving the practical aspects of the treasury management. It was an excellent session, sir. A formal vote of from the Committee on Management Accounting. Thank you so much, sir. Thank you.
Thank you. I log out now. Thank you very much,
sir.
and all the best wishes to the participants. Thank you. Thank you.
Thank you, sir.